In 1999, a company called Pets.com raised $82 million in its IPO. It had a sock puppet for a mascot, a Super Bowl commercial, and almost no revenue. 9 months after going public, it was bankrupt. That same year, a company called Webvan, an online grocery delivery service, raised $375 million and was valued at over $1 billion before it had proven its model worked in a single city. It collapsed 2 years later. And yet, at the peak of the market, investors, those professional investors, could not buy enough of these stocks because everybody believed this time was different. This technology was going to change everything. And anyone who questioned it was just too old to understand. Does any of that sound familiar? I make these videos because I believe that the best financial decisions come from understanding history and not just following headlines. Today, we're talking about the dot-com bubble, not as ancient history, but as a direct, urgent warning for what may be happening in markets right now. We're going to walk through exactly what happened, why it happened, and most importantly, what it means for your money today, whether in your 40s building wealth for your family, or in your 50s and 60s protecting what you've already built. This video is for you. Let's go back to 1995. The internet was real. Let's be clear about that from the start. The World Wide Web wasn't a hoax. It genuinely was going to change commerce, communication, and everyday life. Every analyst who said it was transformational was right. But here's the lesson that almost no one absorbed from what happened next. Being right about the technology is not the same as being right about the investment. In the mid-1990s, the internet began entering mainstream American life. Companies like Netscape, Amazon, and Yahoo were proof that digital commerce was possible. Venture capital flooded into Silicon Valley, and the Nasdaq, the tech-heavy stock index, began one of the greatest bull runs in financial history. From 1995 to early 2000, the Nasdaq rose over 400%. Now, when a market rises 400% in 5 years, one of two things is happening. Either the underlying businesses have genuinely become worth 4 times more, or investors have simply decided to pay 4 times more regardless of what the businesses are actually worth. In the dot-com era, it was almost entirely the second one. Here's how you could tell. In traditional investing, a company's stock price is supposed to reflect something real, like earnings, revenue, assets, and future cash flow. A simple ratio called the price-to-earning ratio, or PE ratio, tells you how much investors are paying for every dollar of profit a company makes. Historically, the stock market trades at a PE of around 15 to 20, meaning investors pay $15 to $20 for every $1 of annual earnings. At the peak of the dot-com bubble, many technology companies had a PE ratio of 200, 500, or even 1,000. Some had no earnings at all, and they were losing money every single quarter. But investors were still paying billions for them. Why? Because the story replaced the math. The story was, it doesn't matter what these companies earn today. What matters is how big the internet is going to be tomorrow. And if you miss this wave, you'll regret it for the rest of your life. That story, that urgency, and that fear of missing out is what drove ordinary families to move retirement savings into tech mutual funds. It's what drove pension funds to overweight technology. It's what created the bubble. And it's a story we've heard before, and we're hearing it again. Economist Hyman Minsky identified a pattern that shows up in almost every financial bubble in history. It has 5 stages, but for our purposes today, let's focus on the 3 that matter most for investors. The first is displacement. Something genuinely new arrives, a new technology, a policy change, a new market. It creates real economic opportunity. Early investors pile in when returns are strong. So far, so good. In the dot-com era, this was the mid-90s. The internet was new. Early investors in Amazon and Microsoft made extraordinary returns. Those returns were, at that point, largely justified. Next is euphoria. The success of early investors attracts everyone else. Media coverage explodes. Expert voices appear on TV every night telling people to buy. Valuations detach from fundamentals. People who've never invested before open brokerage accounts. Your neighbor is bragging about his tech stocks at the barbecue. This is the most dangerous stage because the returns are still going up, so it feels like wisdom rather than gambling. In 1999, this is exactly where we were. CNBC became must-watch television. Day trading exploded, and cocktail party stock tips were flowing. Lastly is panic. The narrative starts to crack. A few high-profile companies miss their numbers. Some go bankrupt, investors begin to question valuations, selling accelerates, and then very quickly the euphoria reverses. What took years to build collapses in months. From its peak in March of 2000 to its bottom in October of 2002, the Nasdaq fell 78%. Let me put that in human terms. If you had $500,000 in a Nasdaq index fund in March 2000 and you were 58 years old, planning to retire in 5 years, by October of 2002, you had $110,000. And the market didn't return to its 2000 peak until 2015. That's 15 years later. Here's what makes the story more than just a cautionary tale. Some companies came out of the dot-com crash and went on to become the most valuable businesses in human history. Amazon lost 94% of its stock value between 2000 and 2001. 94%. If you held on, if you believed in the business model, and you didn't need the money, you participated in one of the greatest recoveries in financial history. Google was founded in 1998, and it went public in 2004. It barely existed as a stock during the bubble. So what separated the survivors from the failures? 3 things. First, a real business model with a path to profit. Amazon was burning cash, but it was building infrastructure with warehouses, logistics, and a customer base. Pets.com was burning cash and had no structural advantage over any pet store in America. Second, a product people actually needed, not just wanted in the moment. Search engines, e-commerce, digital communication. These all solved real problems. Many dot-com companies were solutions looking for problems. Third, financial staying power. Companies with real balance sheets, real cash, and manageable debt survived the credit freeze of 2001 to 2002. Companies that depended on continuous fundraising collapsed the moment investor sentiment shifted. And this brings us directly to today. I want to be careful here. I am not saying AI is a fraud. I am not saying the companies building AI will fail. In fact, I think artificial intelligence is probably one of the most genuinely transformational technologies since the internet itself. But I said the exact same thing about the internet earlier, and we just watched what happened when investors were confused with great technology with great investment at any price. Let's look at the parallels, and let me be specific. In 1999, the Nasdaq traded at price-to-earning ratios of around 175. Today, top AI-adjacent technology companies trade at a PE ratio that in many cases exceed 40, 50, or 60, with the most speculative names having no earnings at all. In 1999, hundreds of companies added .com to their names to get their stock price to rise with no actual change to their business. In 2023 and 24, we watched hundreds of companies add AI into their press releases with the same effect. In 1999, venture capital flooded into Silicon Valley with less scrutiny than at any point in history. In 2023 and 24, AI startups raised hundreds of billions of dollars, many with no clear path to profitability. In 1999, their narrative said, you can't afford to miss this. In 2024 and 25, the narrative says, AI will replace every job, every industry, every business model within years. You can't afford to miss this. Now here's the critical distinction, and this is what I want you to take away from this video more than anything else. The question is not, is AI real? It is. The question is not, will AI change the world? It will. The question is, at what price are you buying into that future? And are you buying the companies that will actually capture the value, or are you buying the hype that surrounds them? In 2000, the internet changed the world. But if you bought the Nasdaq index in March 2000, you waited 15 years to break even. So let's get practical. because history lessons are only useful if you change what you do next. Firstly, diversification is not a punishment, it's protection. During the dot-com crash, investors who were concentrated in technology lost catastrophically. Investors who held diversified portfolios, including value stocks, international equities, and bonds, experienced pain, but they recovered far faster. The S&P 500 fell about 49%, peak to trough. The Nasdaq fell 78%. That 29% difference is enormous when you're living off that money. If your portfolio today is heavily weighted towards technology or AI-related stocks, whether through individual holdings or through index concentration, that's worth examining. Next, know the difference between your accumulation money and your protection money. If you're in your 40s and still 20 plus years from retirement, you can afford to own a reasonable allocation to growth and technology stocks. You have time to recover from a drawdown. What you cannot afford is putting money you'll need in the next 5 to 7 years into speculative positions. If you're in your 50s or 60s, the math changes dramatically. A 40% drawdown when you're 62 and planning to retire at 65 is not a temporary inconvenience. It can permanently alter your retirement income. Thirdly, the best investments in transformational technology are usually not the technology companies themselves. Think about the California gold rush. Who got rich? Mostly not the miners. The people who got reliably rich were the ones selling picks, shovels, denim pants, and provisions. Infrastructure businesses with real cash flows. In the AI era, some of the most consistent beneficiaries are the companies building the infrastructure, like energy providers powering the data centers, semiconductor manufacturers, cybersecurity firms, and established cloud platforms that already have the distribution to monetize AI tools. These are not the exciting names. They don't go viral, but they have earnings, cash flow, and business models you can actually analyze. Lastly, don't let the narrative replace the math. The most dangerous words in investing are, "This time is different." Sometimes things are genuinely different, but the burden of proof should always be on the person making that claim, and that proof should be in the numbers, not in the story. Before you make any significant investment decision based on AI hype, ask yourself, what is this company actually earning today? What does it need to earn to justify this price? How long am I willing to wait? The dot-com bubble didn't destroy investors who understood what they owned and why. It destroyed investors who bought a story without reading the balance sheet underneath it. The lesson from 1999 is not avoid technology. It's know what you're paying for. AI may well be the most important technology of the next 50 years. Some of the companies being built today will be the Amazons and Googles of the 2040s, but some of them will be Pets.com. And the difference right now from the outside is very hard to see. That's why working with an advisor who understands both market history and your specific financial situation isn't a luxury. It's the best investment you can make before the next chapter of this story is written. If you found this video useful, subscribe, because every other week we cover exactly this kind of information, whether it's real financial history or other lessons applied to real decisions you're facing right now. And if you're wondering whether your current portfolio is positioned for the kind of market volatility this era could bring, I'd encourage you to reach out. A second opinion on your allocation costs nothing and could be worth a great deal. I'll see you in the next video.